I'm looking forward to hearing your voice and seeing your screen. Everybody, welcome Craig Erlam.
Welcome,
Craig
Craig.
Hey Craig, how are you? It's so great to have you here. Thank you so much for your time, taking the time to address our community, Craig. You know, I usually have a great memory. You know, I can remember everyone's trades. We've done this before, haven't we? Didn't I interview you in LAR on FX Street?
I think you did. I think that was maybe 2 or 3 years ago now.
Yeah, okay. So, you know, because, you know, when I asked you to come on, I knew that we had, you know, I interviewed over 700 people. I was pretty sure we did this before. So welcome back to dealing with me for another 20 minutes. I think after 3 years, you've had time to recover from your last interview with me, and I appreciate you coming back. So, Craig, you're a market strategist for Oanda and Market Pulse, so you're very well followed. We're having the dollar under extreme pressure with Draghi's statement, so I'm very interested with what you have on your radar screen.
Yeah, sure. Firstly, thanks for having me back on. If you've interviewed over 700 people, I appreciate you actually remembering me. That's a lot more people than I can ever remember. Yeah, I think this week's going to be quite interesting. I think ultimately the summer could be a little bit challenging for the markets, but this week we do have a number of central bankers speaking, so fortunately we do have that on the radar, and for a brief period at least we can stop talking about all the problems in the UK and start looking a little bit beyond the political circus which we have going on here. Yeah, as you mentioned, I think the euro is looking really interesting right now. We looked as though we were seeing it looking a little bit toppy, approaching those 113s. The 113s just being those previous highs, 113, 113, right. 50. We had that lovely breakout.
That was the high on election day. So they finally, well, almost accomplished it.
Yeah, and it was this interesting rejection which just made it just start to look that little bit toppy. We saw it flatten off a little bit. We saw the momentum as shown by the MACD and stochastic below starting to fall out the move. It's always a surefire sign that things are starting to potentially look at potential correction territory. It looked as though we were potentially even going to see that. We saw the break briefly below the channel, but didn't really gather any momentum to the downside. So I think it was really these 111s which was looking particularly key. But then you look today, and when we see these strong rallies on the back of, let's face it, relatively little, it's always a surefire sign that the market is desperate to be bullish. I was hoping, if I'm honest, I was hoping for more of a correction. I was hoping for a move back to at least the 38.2 fib, maybe the 50 fib, just to offer some really attractive levels. But the market is clearly very keen to be bullish, and if we can see a breakthrough these kind of 113s, then it looks like the market's ready for another wave higher, and 113.50, like I say, offers a little bit of another test. But really, if we break through these 113s, I see no reason why we can't be looking back towards these kind of 115, 116 levels, and I don't think we'll have to wait too long. But like I said, I think what I would like to see, rather than what I am expecting to see, is a bit of a healthy correction here, because it's been a very aggressive rally, and we haven't had that healthy correction, which I think is always warranted. And looking back
which means that maybe we're close, because retail traders are very long the euro, and
absolutely.
I'm not saying that they're never right, because you know what, we're retail traders. Newsflash. Anyway, so you know, we're always saying, oh, the retail trader is too long, but you know, who are we? I'm not. I've been in an institution, but I'm not an institution. So maybe we're getting close here, Craig, to where that type of shakeout could occur, because if the Dixie doesn't turn here, it could turn into, you know, kind of a bloodbath. So maybe we're getting close. Maybe peg it with a high, possibly in euro pound up around 90. Because, you know, I teach, as long as euro pound is bullish, your preferred long is the euro and your preferred short is a pound, and we're not quite there, but we're getting close. Do you have a view on euro pound?
Well, yeah, I mean, just a briefly go back 1 second, I think I completely agree with what you're saying there. And looking at the chart which you had on your screen about 5 or 10 minutes ago, the U.S. Treasury, maybe that is a signal that we are going to see a little bit more dollar strength, and hopefully the two moves can coincide, because I think, again, a healthy correction in the dollar wouldn't do the markets any harm whatsoever. And to an extent, I think it would be quite welcome. So I think the markets are underestimating the Fed, at least for this year. The idea that we won't see another rate hike this year seems a little bit far-fetched to me, considering they are clearly determined to do one more. Euro pound, again, I'm in complete agreement.
Since you bring it up, though, Craig, and I know that you have an economic background, that you're not just a technician. You think about the fundamentals. The data hasn't been that strong in the U.S. Why do you think the Fed is in a tightening mode and may continue to be aggressive? What's the reason?
I think there's a number of factors. I think, for one, the Fed's not in a tightening mode, but it's also in no mood. It's not the data doesn't support necessarily tightening per se. But I think the Fed's in no mood to fall behind the curve, and I think they're looking at the models and they're seeing unemployment's very low. And I think what they're looking at is the potential for inflation to pick up, and they're desperate not to fall behind the curve. I think that's one thing that they've made perfectly clear. I think another thing as well, I think they're looking at the cyclical aspect of the economy, and they're saying, right, we're now, about 9 years into this current cycle. I think this is the third longest growth cycle that we've ever seen in the US, and it's far longer than the average already. And I think they're looking at this and they're saying, we are in a position right now when, yes, maybe the data doesn't justify it, and if we were in the third year or fourth year of this cycle, then yeah, we'd probably hold off a little bit longer, and we could enable ourselves to take this little bit of more of a risk. But we're not. We're in the 9th year of this cycle, and we need to prepare for the scenario whereby if we do see another downturn and we see another recession, we've got some decent tools in our kit that we can use in order to offset it. And I think I think that they're also looking at the data saying, yeah, it's not great, but it's not bad either. We can afford to raise interest rates without damaging the economy, and I think that's why they're so intent on doing so.
Also, they have the 2400 S&P. But you know what? I wanted to hear your answer, because that confirms. That's my belief, is that they're worried about not inflation, but the next recession, and they want to have a cushion so they could take rates back down if they need to. So thank you very much for your insights on that. Are you based in the UK?
Yeah, London.
Okay, then what do we do with cable here, Craig? You're there, you should know. I'm in San Diego. What would I know about the cable?
So yeah, cable, again, it's an interesting one, because in one way, I think we are at these kind of levels. I think we're very oversold. I think the market is heavily priced in a hard Brexit. I think there's been too much attention paid to the rhetoric, to the political posturing, which we've seen from both the EU and the UK over the last 6 to 12 months. And I think there's almost this case where we're fearing the worst, and I don't think the worst is going to happen. Yes, both sides have to play a strong game and have to sell to their own electorate, but the reality, I think, is there is going to be some form of compromise. I think the UK will probably be a little bit worse off than it would have been inside the EU, but that doesn't mean we're all of a sudden going bankrupt either. And I think when we're looking at the levels that cable's at currently, I think we're pricing in far too deep a downturn. I think we're pricing in far too hard a Brexit. So we may languish around these levels for a little bit longer, but if you're talking 12 months down the line, 18 months down the line, I'm not looking anywhere below these kind of 120s to 125s. I'm looking back towards hopefully around the 135s to 140s, and I think we could even potentially go a little bit above that when we soon realise that there's going to be a transition deal. This is going to be a much longer process, and if the transition deal is 2 to 5 years, then that's 2 to 5 years when our economy is hopefully going to have more certainty and stronger levels of growth, and hopefully we don't hit a recession in that time. But there's little signs at the moment that we are going to. So I think we are languishing around the lows. There's no reason why we can't stay here for longer, though. I think you look at this right now, we're stuck between these kind of 126s, 128s. We could pop high.
I would try it. I would try it down there if we got some bad news and we just went down one more time under 126. I would try it there. I think you make some great points. How about this? Craig, I was taught, and I've been around for a while, that what happens in the UK leads what happens in the US. Like, to me, the FTSE looks weaker than the S&P, so it looks like it could lead the correction to the downside. And if we're in a tightening mode, this is probably the first time in my career that I've seen the US ahead of the UK in any kind of cycle, easing or tightening. Perhaps what finally takes a pound up, Carney's pretty slick. What would it take for him to stop sounding like a dove? And do you think he could flip and start talking about being a little more hawkish, and possibly a rate increase is the last thing anyone's looking for in the UK in the face of Brexit?
Well, I think the first and foremost, I think before we hit the possibility where Mark Carney turns more hawkish, and I do obviously think that's a possibility, I think that we've got to face the prospect that Mark Carney is not going to have the influence over the Bank of England that past governors will. We saw the vote of 5-3, and of course that included Kristen Forbes, who leaves the Bank of England at the end of this month. But it shows that people are willing to go against Mark Carney. We heard Andy Haldane, who's one of his closer colleagues, and he also came out only 24 hours after Carney last week and said that while he didn't vote for a rate hike previously, the way the numbers are going, he would consider doing so at one of the future meetings. So he's not driving the consensus that governors previously do. So I think that's the highest possibility. Is that
okay? So he may cave. He may cave because he's not leading the central bank like Yellen is. So it's a little different situation.
He may. I'm not sure he'll cave. I almost think he will go down swinging. He will be one of the losing voters, and other policymakers will move against him. I think the thing that will make him cave would be not just higher inflation. I think inflation would have to hit closer to 3.5% than 3% for him to start considering the idea that their analysis is incorrect. I think things like inflation expectations are the ones that we should be keeping a close eye on, because this is something he refers to repeatedly. And if inflation expectations keep rising, then that could be the type of thing that makes him think that this is more than just a currency-inflicted inflation move, and that the consumer behavior is being influenced by it, which will ultimately feed back into those.
How about real estate prices, Craig? Are they still on fire there in the UK?
They've cooled.
They've
certainly cooled, particularly in London, not as much as Carney would like. I think in the financial stability report earlier on, actually, he did refer to house prices, and in parts that they are still a little bit high. Note, it was interesting earlier that they increased the counter-cyclical buffer as well from 0% to 0.5%, and indicated a willingness to increase it to 1% in November. This seems to have bypassed a lot of people, but the counter-cyclical buffer is, I believe it was what was cut back in August along with interest rates in order to try and free up some extra stimulus in the economy, and that's what they've done today. They've increased the buffer. Now, that I was very curious to see how the pound was going to trade today, simply because if they are increasing that buffer, is that a compromise on behalf of Carney that says, yes, I don't think we're ready for higher interest rates yet, but what I will do is I'll increase that buffer again. I'll undo that move that we did back in August, an effective slight tightening, but maybe that's the compromise which they've come to in order to appease some of the more hawkish policymakers, and that buys him an extra 3 to 6 months on the inflation side. So I'll be very interested to see how the pound trades in the coming.
That's a great insight. I'm glad I asked you about the real estate market. I didn't know that was going on. So they have more tools than just raising funds rate. So that may be a tool that's interesting that you bring that up. So why don't I ask you a question that no one can answer? What's going on with the yen, Greg? U.S. dollar yen, I mean, we've had false breakouts over trend lines, and it fails. Here we are again, breaking out again to the upside, and it's doing it in the face of a pretty weak dollar. So what are you thinking in here? And I see you have some cloud patterns on here, etc. That hasn't done anything wrong yet. That's all I could say.
No, the yen has been, I find it one of the most frustrating currencies, to be quite honest, because fundamentally there seems to be very little reason to be long the yen. It seems to be the only central bank that isn't even pondering the idea of tightening policy or removing any form of accommodation. The economy is showing very gradual improvement, but very little at the, nothing substantial. Anyway, we're not in a majorly risk-averse environment, which would typically benefit the currency, and yet it seems to be performing quite well anyway. I think what we're actually seeing quite an interesting move in dollar yen right now, and again, hopefully this is something that's coinciding with the analysis on the US Treasury earlier on. Of course, if US Treasury prices fall, that means yields rise, and that would typically be beneficial for the dollar. And what we're seeing right now is, as of literally today, we're seeing the price action breaking above the cloud here, which would be typically take it into bullish territory, but which is a little more rare. We're seeing the lagging line, which is the confirmation line, also breaking above the cloud at exactly the same time. So should we see a nice little break here up through that 112, then I think this could be a very, very bullish signal for dollar yen, and could coincide nicely with the Treasury position that you were talking about earlier. And should we see a break above here, then I think we could maybe be looking back towards these kind of 114s, 115s, and this is then a very interesting zone once again. I think longer term, we are still kind of, we're just range bound really in dollar yen at the minute. It seems to be since the start of the year really, there doesn't seem to be a broad consensus on where this pair's headed for now. We've got a nice big range, but I mean, you just look at these lines here and it's very just sideways bound. So I think a big test would come around these 114s, 115s, but hopefully at least in the short to medium term, we could be seeing a very nice little bullish breakout right now.
Okay, thank you for that, and nice view. I'd like to get your comment on what happened in the precious metal pit yesterday. You know, my handle is at Forex Stop Hunter, so you know I'm all for it. When I was on the floor, you'd hear a roar on the floor every time they ran stops. I noticed that after the stops were run, people would sell into buy stops, buy into sell stops, and they were at least temporary highs and lows maybe for the session. But yesterday, what happened in the precious metals, you know, kind of stinks for traders, because the way it was, the way it happened all in 1 minute. If you ever want to see a stop hunt, that was pretty classic yesterday in the silver and gold. What do you think is going on with the structure of the market for, you know, they're saying fat fingers. I mean, we had a fat finger in Amazon a few weeks ago. We're having these fat finger events everywhere. I don't know if they're fat fingers, but what's your view on that and then the commodity currencies in light of it?
Okay, so I mean, this is the gold move you're talking about, just to bring another chart in.
Yeah.
So this is the sell-off which we saw. There's one reason why I find it hard at the moment to buy overly into the fat finger idea, is simply because we did retrace some of the gains, but it took a long time to retrace those gains. Usually in these fat finger scenarios, the moves are reversed quite rapidly.
That's a pearl, Craig. That's a pearl, okay? Because that's something that I'm going to be thinking next time, is how quick is the recovery off some type of spiking event. So, you know, that I talk about, it's not just the price, but how it gets there. So that's pretty insightful to watch if it's a struggle after an event for a market to recover. Beautiful.
Exactly. So we saw the big move, and of course it seems like the speculation was that it's come from a very large trade in very liquid environments, something that we've got to become accustomed to, I think, because there's a number of factors at play here. One, we keep seeing these large trades in the liquid environments. The pound has been one of the biggest victims of this since last year's Brexit vote. We've seen 2 or 3 occasions where the pound has moved in a significant amount, a very short period of time, because of large trades in a liquid trading. What that does is it triggers 2 things. It triggers the stop losses. You say yourself, you stop loss hunter. You know that it's going to trigger a wave of stop losses, which is going to exacerbate the move much further. So you will always see some form of correction because the move will always be overdone to an extent. I think there's also the fact that we've got to accept the fact that these trading algos do play a part in these moves. So when you start to see these stops being triggered, I think that's where the algos kick in, which exacerbates the move that little bit further.
Well,
and I think it's just one of these.
Talking about exacerbation, the silver actually was even a little bit more criminal than the gold, because people that would have had stops under the lows in gold, they're still alive, right? They could have their stops under the May lows, but look at the silver. They took every potential long out for the last 5 months, no matter where their stops were. So to me, that was really the key move, is what happened with silver. So where are you at on Aussie and Kiwi with this type of price action, and also maybe a little bit on Canada that's been under pressure despite the correlation of weak crude? That correlation has broken down.
Yeah, I mean, I think dollar CAD's looking incredible right now, to be quite honest. So I'll come to that one in a second. I think one of the things that strikes me about the Aussie is, of course, it's got its commodity linkage, but we're looking at these levels now around 76, 76.50, just shy of 76.50, call it 76.35. And how many times have we seen these long upper wicks forming? Are these, I feel like we're getting warning signals one after the other. We don't have the upper wick here, but we did see the immediate reversal to the downside from these levels. We'll test this once again, and it's been rejected for a fourth or fifth time. I think this is potentially suggesting we're heading a little bit lower. We are continuing to drive high, but the strength of these rejections I don't think we can ignore right now. So it's going to be very interesting to see how we trade back around these kind of 75.35s should we test that over the next few days, because like I say, we've got a confluence of moving averages there. It's clearly been a key zone, especially over since the start of May, and all of these rejections really do scream that it does really suggest to me that these are warning flags all over the place. But like you say, dollar CAD, I think it's looking absolutely great, fantastic at the minute, because we've had this very long-term rising channel, really. May last year, a year of a rising channel. And let's face it, from a fundamental perspective, the dollar CAD was looking bullish. We've got the US economy, which seems to be on a different path to everyone else in the world. We've got the fact that Canada, with the oil link, seem to be struggling. We've got the fact that there's all these reports about the housing market, about extremely high housing valuations and the issues which could result from here. And yet the Canadian dollar just continues to strengthen, continues to strengthen. The hawkish rhetoric coming from the Bank of Canada, the stronger retail sales figures, etc. And but what this has led to now is we've got this rising channel, which has been a year in the making, and we break below it. And then we had this little bit of consolidation, but even then the consolidation is slow. I think this is always the big giveaway. Where's the slow moves appearing? Here we saw the slow moves appearing to the downside, gradual, and then we burst higher. Here we burst lower, and then we gradual.
Yeah, real gradual there. And that was with crude collapsing up there. So what you say is gradual equals corrective, and what you see as rapid is impulsive.
Well, if you think about it just psychologically, a gradual move higher suggests a significant resistance to that move, and while it is continuing to push higher, that significant resistance, as soon as the buyers give way, in this case, then you see these big aggressive moves. You see this candle here, I think is particularly interesting. You see the move now that we've seen today. We've now seen a long-term channel which has been broken. We've broken back below it once again. We had this short-term corrective move, and now we've broken through it quite aggressively again. I think this is potentially looking quite bearish right now. I think the 130s, if we can reach those levels, and I think that'll be extremely interesting because that's a very long-term support here. But we're looking at these moves here, and I struggle to see any reason why this isn't bearish. We even look at the momentum indicators, and they seem to be very much supportive of further downside in this dollar Canadian pair. I think if we can trigger this move below these kind of 130, 180s, then I think 130 looks very much on the cards.
Okay, great look, Craig, and what a great interview. I'm so
Thank you very much for having me.
Yeah, I'm so glad that I reached out to you again and brought you back. I learned from you today. I really some great insights about, after spike events, watch the nature of the move in a recovery, and some very good looks and these different instruments. So I know that your Twitter handle is Craig_Forex. What's the best way? And I do encourage everyone that is listening to us live or here's a video that you follow Craig for his views. People could also get your views on Market Pulse.
That's right, www.marketpulse.com. You can get a lot of the analysis which we post, as well as some of the other analysts as well.
Okay, so that's kind of like the analyst's arm for Orlando.
That's right, yeah. So so we've got
Okay.
analysts around the world, Toronto, Singapore, Israel, etc., and of course London, and we all post our commentary up on there.
Okay, let's see. Oh, Craig, one last question. Where do you see the gilts going from here?
Gilts. See, I still see yields staying quite low. As far as I'm concerned, I'm still of the belief that we shouldn't, and that we probably won't see an interest rate rise until after the Brexit negotiate, until after, say, March 2019. I think it's given the way the data is looking and given the way the economy is expected to perform in the interim, I think raising interest rates in the meantime, in the face of just due to the currency moves, I think is quite frankly ridiculous. And I think as long as the bulk of the MPC members agree with me, then I think that should keep yields quite low.
Thank you, Craig Erlam, my trading warrior brother. May pips rain down on you and everyone whose words you touch. And I really, really appreciate you. Thank you, Craig, for coming in today and enlightening me and everyone else.
And keep up the good work, guys. Cheers.
Thank you, guys. Thank you. Thank you, Face. Thank you, Steve Volge. Thank you, Blake. Thank you, Nick. Thank you, Velu. Thank you, Stelios, who was a TV star today. Now you did an interview. And thank you very much, guys. Sign up. Remember how many man hours these guys go through to have this information at their fingertips. And most of all, don't just count your pips, count your blessings. See you tomorrow. I have Walter Vanelli lined up for tomorrow. Walter has no axe to grind. He doesn't sell anything. He's just a trader who makes a lot of money trading his own account. So see you tomorrow for Walter Vanelli. Adios, my trading warrior brothers and sisters. Enjoy the summer. Adios.